The U.S. is choosing inflation over austerity as debt soars past wartime levels. But could this strategy quietly shift the burden onto everyday Americans? U.S. Treasury Secretary David Bessent revealed the federal deficit is 6.7% of GDP, the highest in peacetime. Instead of cutting spending, the government plans to rely on nominal GDP growth, mainly from inflation, to keep the debt-to-GDP ratio stable. This strategy effectively repays bondholders with devalued dollars, meaning bond yields may rise nominally but lose real purchasing power, an indirect form of debt debasement. For average Americans, this means rising prices without a proportional increase in wages or savings. Pensions, 401k plans, and insurance funds tied to Treasury securities may underperform. Meanwhile, inflation quietly reduces the value of fixed incomes, hurting retirees and low-income households. The very instruments once considered safe may become a stealth tax on the middle class. Ratings agency Moody's has downgraded U.S. credit, triggering a spike of 10 basis points in 10- and 30-year Treasury yields. Once seen as the global gold standard, U.S. Treasuries are now being re-evaluated as higher-risk assets by international investors. At the same time, Washington plans to borrow trillions more over the coming years. As confidence erodes, market volatility could increase and bond prices may remain under pressure, raising borrowing costs. Further, rising bond yields translate directly into higher interest rates on mortgages, credit cards, and business loans. This can squeeze consumer spending, slow home buying, and chill investment. Even government interest payments, funded by taxpayer dollars, could balloon, diverting money from schools, infrastructure, and healthcare to cover debt service. The U.S. is reigniting trade tensions, with both former President Trump and Treasury Secretary Bessent vowing to impose steep tariffs on countries deemed uncooperative. The new stance demands removal not only of tariff barriers, but also of subsidies, VAT schemes, and currency controls, despite the U.S. itself employing tools like the CHIPS Act and corporate tax breaks. As rhetoric heats up, key partners such as Japan, the EU, and China are pushing back, signaling renewed fragmentation in global trade alliances. Consumers may see prices rise on imported goods ranging from electronics to clothing. U.S. exporters could face retaliatory tariffs, hurting agriculture and manufacturing jobs. Multinational firms may delay investments or shift supply chains, introducing longer-term economic uncertainty. A fragmented global trade network ultimately weakens American economic leverage. China is benefiting from Western contradictions, with subdued inflation and a 10-year bond yield of 1.67%, well below U.S. levels. Manufacturing growth has exceeded expectations at 6.1%, supported by subsidies and policy consistency. Meanwhile, the U.S. relies on deficit spending and inflation, risking a slowdown or a Fed bailout if rates rise or inflation persists. While China stabilizes and expands its economic influence, Americans face higher costs and weakening investment returns. U.S. global influence could decline if domestic instability continues. The long-term result may be a shift in global power as rivals gain ground through discipline, while the U.S. spends its way into fragility. Over $2.5 trillion in Asian dollar reserves may be offloaded, while the U.S. faces growing isolation in global trade. How might a shifting economic order in Asia impact American households and jobs? Over $2.5 trillion in U.S. dollar reserves held by Asian economies could soon be sold off, according to economist Stephen Jen. This reserve buildup stems from decades of trade surpluses with the United States and has traditionally been invested in U.S. Treasury bonds, real estate, and equities. The Bloomberg Dollar Index has fallen 9% since January 2025, while regional currencies like the Chinese yuan, Taiwanese dollar, and Malaysian ringgit have all appreciated in recent weeks. These moves suggest a gradual diversification away from the US dollar in central bank portfolios across Asia. If this sell-off accelerates, the dollar may weaken further. A weaker dollar typically drives up the cost of imported goods. For American families, this could mean higher prices on everyday essentials, such as groceries, gasoline, and electronics, exacerbating the ongoing pressure from consumer inflation. China and Japan and South Korea have signed a new agreement to deepen trade cooperation, marking a pivotal shift in regional dynamics. The accord aims to ease long-standing diplomatic tensions and bolster joint supply chains, reinforcing the existing Regional Comprehensive Economic Partnership, or RCEP, the world's largest trade deal. Analysts see this as a significant move to establish a trade architecture independent of US-led systems, effectively redefining Asia's economic future without American oversight. With tighter Asian integration, American firms could face steeper barriers to entering key East Asian markets. This realignment threatens US exports and may prompt some manufacturers to relocate or lose competitiveness, posing risks to jobs in tech, auto, and industrial sectors. The U.S. is increasingly viewed as a trade outlier, according to a recent Telegraph report, which highlighted global skepticism toward America's economic reliability. Critics cite unilateral tariffs and financial sanctions as key reasons why nations are recalibrating away from U.S. trade norms. IMF data shows the U.S. dollar's share in global foreign exchange reserves has dropped from over 70% to below 60% in the past 2 decades. The erosion reflects waning trust and a broader desire for multipolar economic leadership. As trade partners seek alternatives, U.S. exporters, particularly in agriculture, manufacturing, and technology, may face declining demand, reducing profits, and putting jobs at risk in trade-dependent regions of the country. Russia and China have shifted most of their bilateral trade into their own currencies, bypassing the dollar entirely. Speaking last week, Russian President Vladimir Putin confirmed that a majority of Russia-China transactions are now settled in rubles and yuan. Simultaneously, countries in the global south are investing in new payment systems and financial platforms to avoid using the US dollar, reflecting a growing push for de-dollarization. A diminishing role for the dollar in global finance could raise borrowing costs at home. As international demand for dollar-denominated assets declines, interest rates on mortgages, car loans, and credit cards could rise, making debt more expensive for American consumers.
The ongoing US-China trade war is escalating, with bold moves from both sides. China is preparing strong measures, ranging from tariffs to financial strategies, in an effort to reverse the tide of the conflict. But will these actions be enough? The trade war between the US and China intensified further, as US President Donald Trump announced an increase in tariffs on Chinese imports to 145%. This new tariff includes 125% retaliatory tariffs and an additional 20% surcharge that was applied earlier. In response, China announced a 125% tariff on US goods. However, the Chinese government stated that it would not back down or continue participating in the tariff escalation. China explained that the current tariff levels have already surpassed what is acceptable and have negatively impacted bilateral trade. It emphasized that further tariff increases would not improve the situation, but would only make trade relations between the two nations more unrealistic. China is now looking to shift towards diplomatic measures and dialogue, but insists that the terms of the trade agreement need to change in order to reach a long-lasting and fair resolution. Chinese President Xi Jinping spoke out about the trade war with the US, asserting that China would not succumb to suppression and would not make concessions in this confrontation. His statement came shortly after the U.S. imposed tariffs on Chinese goods and threatened to escalate its retaliatory measures. President Xi emphasized that China has developed independently for over 70 years and does not need help or preferential treatment from any other nation. He firmly stated that China would not yield to external pressure, reinforcing that the country will maintain its stance and continue to develop in its own way, unaffected by outside measures. U.S. President Donald Trump has also expressed his willingness to work with China to find a solution to the trade dispute. However, with China's firm stance, achieving a resolution may prove to be even more challenging. Simultaneously, China issued a travel advisory for its citizens traveling to the U.S. The advisory urges Chinese nationals to carefully assess the risks before planning trips to the U.S. and encourages cautious travel. This not only affects tourists, but also impacts Chinese students studying in the U.S. The warning could lead to a reduction in the number of Chinese visitors to the U.S., which would significantly affect the tourism industry and trade activities between the two countries. China currently holds approximately $760 billion in U.S. Treasury bonds, making it one of the largest creditors of the United States. This provides China with a powerful tool to pressure the U.S. economy should it choose to sell off these bonds. While this is a double-edged sword, as selling U.S. debt would also have negative consequences for China, it could still be used as strategic leverage in the trade war. However, China is fully aware that such a move could pose significant risks to its own economy, and thus, it will carefully consider this action before proceeding. The outcome of this escalating trade conflict remains uncertain, but China's firm responses and strategic preparations indicate a determination to stand its ground in the face of increasing pressure from the United States. President Donald Trump has stirred significant discussion in the political arena with his pragmatic foreign policy approach, where the United States, China, and Russia dominate global influence. The question remains, can this strategy reshape the global order? Or is it a risky move by Trump? In early 2025, President Donald Trump proposed renaming the Gulf of Mexico to the American Gulf, arguing that the region holds strategic importance for the U.S. He emphasized the Gulf's vital role in maritime trade and resource extraction, particularly oil and natural gas. This proposal caught the attention of the Mexican government, with President Claudia Sheinbaum expressing concerns that the name would be inappropriate and disrespectful to the region's historical heritage. Mexico has since made efforts to protect the name Gulf of Mexico on international maps. Throughout his presidency, Donald Trump developed a unique relationship with Russian President Vladimir Putin, even amid escalating tensions over the situation in Ukraine, where Russian forces continue their offensive. Meetings between Trump and Putin, especially the 2018 Helsinki summit, sparked controversy among international observers. Trump not only refrained from criticizing Putin for his interference in the 2016 U.S. elections, but also proposed closer cooperation between the two nations. Recently, Trump has again criticized U.S. foreign policy, suggesting that he might be the only leader capable of resolving the Ukraine conflict swiftly, though many view this stance as unrealistic, given the ongoing conflict and unresolved tensions between the two nations. Trump's leadership style, often described as transactional, has raised considerable debate. Throughout his term, he predominantly approached both domestic and international issues from the perspective of personal and national interests, rather than moral values or long-term leadership principles. He frequently sought short-term deals beneficial to the U.S. A clear example of this was his approach to trade relations with China, where he imposed high tariffs on Chinese goods, relying heavily on the power of sanctions and tough negotiations, rather than seeking long-term cooperative agreements. His views and actions have not always been predictable, and their instability has led to concerns about the absence of an overarching strategy in foreign policy. Donald Trump has made notable efforts to facilitate ceasefire agreements in the Middle East, particularly in the Israel-Gaza conflict. One of his significant actions was negotiating and facilitating a ceasefire agreement in early 2025 between Israel and Palestinian forces. However, his proposals, especially regarding Gaza's future, met with strong opposition from hard-right Israeli groups, who criticized him for not adopting a tougher stance toward Gaza and Palestine. Despite these reactions, rumors suggest the possibility of a new ceasefire agreement, potentially tied to Trump's upcoming visit to Saudi Arabia next month. President Donald Trump holds a clear strategic vision for the global power structure, which he believes will be dominated by three major powers: the United States, China, and Russia. In Trump's view, these nations will take center stage in global affairs, with the U.S. intervening in strategic regions, including the Asia-Pacific, the Middle East, and Europe. He focuses on safeguarding American interests, particularly through hardline trade strategies with China, aimed at reducing trade deficits and protecting domestic industries. Simultaneously, Trump has shown a degree of support for Russian policies, especially in Ukraine and Syria, reflecting his pragmatic foreign policy approach that prioritizes short-term agreements. Financial markets are rattled as the U.S.-China trade conflict enters an unprecedented phase. Interest rates are climbing, and the U.S. dollar is losing ground. What lies ahead for the American economy? As of April 11th, U.S. financial markets have experienced notable declines. The S&P 500 has dropped 8.8% since the start of the year, while the NASDAQ composite has fallen 13.4%. The Dow Jones Industrial Average is also down 5.5%. Alongside equities, the yield on 10-year U.S. Treasury bonds has climbed to 4.5%, reflecting concerns over inflation and potential future interest rate hikes. The U.S. dollar has weakened, particularly against the euro and the Japanese yen. In contrast, gold prices have increased as investors shift to safer assets in response to currency depreciation and ongoing market instability. Over the past week, President Donald Trump announced a significant increase in tariffs on Chinese goods, bringing the total rate to 145%. This includes a 10% base tariff, a 125% reciprocal tariff, and an additional 20% aimed at addressing fentanyl-related issues. These measures are intended to encourage domestic manufacturing and reduce reliance on foreign supply chains, especially in critical sectors such as semiconductors and pharmaceuticals. China responded by raising tariffs on U.S. imports to 125% and stated it would not escalate further, regardless of future American actions. Additionally, China has imposed restrictions on the export of key resources like rare earth minerals, impacting U.S. defense and high-tech industries. These developments have contributed to global market fluctuations, with record gold prices, rising bond yields, and a continued weakening of the dollar. Across Europe, several countries are actively exploring deeper economic ties with China. Recent talks and agreements between the European Union and Beijing underscore a growing shift in international trade dynamics. One prominent area of cooperation is the electric vehicle sector. The EU and China are discussing the implementation of a minimum pricing mechanism for Chinese EVs imported into Europe, which could replace the current high tariff structure. Previously, the EU imposed tariffs of up to 35.3% due to concerns about state subsidies. but the ongoing negotiations aim for a more balanced and sustainable solution. Beyond EVs, discussions are also advancing in renewable energy and clean technology. During a recent visit to Beijing, Spanish Prime Minister Pedro Sánchez highlighted the importance of strengthening bilateral trade and investment in these emerging sectors. President Trump came under scrutiny last week following a social media post made on April 9th via Truth Social, in which he stated, "Now is a great time to buy," alongside the stock symbol DJT, referring to Trump Media and Technology Group. Just hours later, the administration announced a partial delay in retaliatory tariffs, maintaining a 10% base tariff on most trading partners. The timing of the post prompted concern from several Democratic senators, including Chuck Schumer and Elizabeth Warren, who have called on the SEC to examine whether the post may have provided an unfair advantage to those close to the president. On April 9th, DJT shares surged by 21.67%. Additionally, a video shared by White House communications aide Margot Martin appeared to show President Trump suggesting that some of his associates had benefited significantly from the market activity, raising further questions about potential misuse of privileged information. According to data from Freddie Mac, the average 30-year mortgage rate in the U.S. has fallen to 6.62%, marking the third consecutive week of decline. Despite this, broader economic sentiment remains fragile. The University of Michigan's Consumer Sentiment Index dropped to 50.8 in April, down from 57.0 in March, reaching its lowest point since 1981. At the same time, short-term inflation expectations rose to 6.7%, reflecting growing concerns over rising living costs and economic uncertainty. Major financial institutions, including Goldman Sachs, have revised their outlook, raising the probability of a U.S. recession in 2025 to 35%. These projections are driven by the combined impact of trade policy uncertainty and continued market volatility. EU diversifies partners, looks to internal market to counter potential 144 billion euros loss. Could these strategies safeguard Europe's supply chains and global standing against pressure from Washington? In 2023, the European Union was the world's largest trading power, accounting for 16.1% of global trade, valued at 7.6 trillion euros, according to Eurostat 2024. The U.S. remains the EU's largest trade partner, representing 17% of EU trade, equating to 1.6 trillion euros. However, this trade relationship lacks any free trade agreement, FTA, protection. Under former President Donald Trump, the U.S. imposed tariffs of up to 25% on imported cars from the EU and 10% across the board. Alarmingly, Trump's trade advisors are suggesting a return of a 20% tariff on all EU goods within the first 3 months if he re-enters the White House, according to Bloomberg. According to the European Commission, a retaliatory tariff war at 25% could reduce EU exports to the US by 17.5%, causing a direct loss of 0.54% of the EU's GDP, which is equivalent to 144 billion euros, according to a European Commission trade impact study. US consumers would face sharp price increases on imported goods from Europe, including cars, wine, and industrial equipment. The Brookings Institution predicts core inflation could rise by an additional 0.3 percentage points if these tariffs are reinstated, according to Brookings. To reduce dependency on the US, the EU is accelerating FTA negotiations with emerging economies. India is a top priority. If an FTA is concluded, the import tariff on cars could drop from over 100% to just 10%, according to Reuters. Bilateral trade between the EU and India is projected to reach 167 billion euros by 2026, with EU exports totaling 75 billion euros and imports from India reaching 93 billion euros. Additionally, a deal with Mercosur, Brazil, Argentina, Paraguay, and Uruguay could boost total trade to 126 billion euros, with the EU exporting 77 billion euros and importing 49 billion euros. For Mexico, improving market access alone could increase EU exports by 20%, or 10 billion euros. In total, if all three FTAs are approved before 2026, the EU could recover around 91 billion euros, though it would still fall 53 billion euros short of the losses from the US. Alongside expanding partnerships, the European Commission is calling for improvements to the EU's single market, established in 1993. While barriers to goods have been removed, three key pillars, services, capital, and labor, still face significant hurdles due to national laws. For example, Polish plumbers must recertify to practice in Belgium. Startups in Portugal struggle to raise funds from the Netherlands due to differing investment laws. And EU citizens face bureaucratic obstacles when working in other member states. According to a new study by the European Parliament, this lack of integration costs the EU 1.1 trillion euros annually, 279 billion euros from services, 415 billion euros from the digital market, 300 billion euros from goods, and 50 billion euros from public procurement, according to European Parliament policy study. If reforms are implemented, the EU could fully recover the 144 billion euros loss from US tariffs, while also boosting its internal competitiveness. China has just halted all capital flows into the United States. This is triggering a shockwave across the global financial landscape. Businesses are reeling. Prices are on the rise. Could this be the beginning of a silent yet significant currency war? According to Bloomberg, as of March 17, 2025, China has officially banned outbound capital flows to so-called hostile countries, including the United States. This expansion of its capital control policy has brought Chinese foreign direct investment in the U.S., which had already fallen from $46 billion in 2016 to just $2.3 billion in 2023, down to virtually zero. At the same time, China has continued to sell off U.S. Treasury bonds, offloading $14 billion worth in 2024 and reducing its total holdings to $775 billion, its lowest level since 2016. A continued reduction in Chinese demand for U.S. bonds could put upward pressure on interest rates. That means higher borrowing costs for homes, vehicles, and credit cards for American consumers. Conversely, in the first quarter of 2025, China increased its investments in ASEAN nations by $19.4 billion. This shift may enhance Southeast Asia's ability to attract infrastructure and technology investment. Additionally, China has accelerated the use of its digital yuan, which is now integrated with the SWIFT Light payment network in 13 countries. This enables transactions without using the US dollar. In 2023, foreign direct investment into the United States hit $148.8 billion, a 28% drop compared to 2022. That's well below the 2014 to 2022 average of $265.6 billion. This downturn has made it harder for businesses to expand and hire, especially in manufacturing, where foreign capital is crucial. And that's putting pressure on employment and household income. As of December 4th, 2024, just $59 billion in new high-yield or junk bonds were issued, lowest level in over a decade. Nearly 80% of that used for refinancing, not growth. It shows a widespread sense of caution among investors and corporate leaders. Meanwhile, average interest rates on junk bonds jumped from 5.2% in 2022 to 9.6% in 2024. Borrowing is now way more expensive. That means businesses may scale back on investments, cut hiring plans. And that could mean fewer job opportunities and higher consumer prices. In summary, the slide in FDI and the contraction of the junk bond market are putting serious financial stress on businesses. Market confidence is taking a hit. And the cost? It's showing up in everyday life.